Welcome everyone back to WWTA News. We're not doing news today. Well, we're not going over any articles, but today I want to talk about. I want to talk about a security. All this stuff in the news in the crypto space, talking about securities. Gary Gensler, the Commodities Future Trading Commission, so on and so forth. And with us being in that space, it's kind of important that we know what we're dealing with and know what we're involved in. I kind of want to review a few things. We'll go over some definitions. We're going to look a little bit deeper. But before we start, if I can get you to hit that like button, please hit that like button. Don't be scared of it. And also share this video to family and friends and loved ones and those who you think might need to hear some of this information. As usual, now let's jump in because it's important that we figure out this whole security thing that's going on because it might go over a lot of people's heads, and I don't think it should because I really don't think it's that complicated, and that's just my personal thoughts and feelings on that. But let's just dig in and see what we can find out. Would you like to find out? I want to find out. Let's dig in. All right, so a security is a thing deposited and this is a definition, or pledged as a guarantee of the fulfillment of an undertaking or the repayment of a loan to be fortified in case of default. Wait a minute. A thing that's deposited, all right, so you got to be able to deposit it, or you can pledge it, right, so it's tangible. You can pledge it, right? I assume it's tangible, as a guarantee. So, hey, look, I'll give this as a guarantee, right? That's like kind of like an asset, right? Something that you can hold until I repay this debt. Yeah. Of the fulfillment, right? Of the fulfillment of an undertaking of the repayment of a loan to be fortified in the case of default. So yeah, something that I can promise you in regards to that loan I've taken, right? So when you hear them talking about doing bonds on like for instance Bitcoin, like Bukele was talking about, it's kind of okay. So you want to draw up a bond, make a contract based on what I have as an asset used as a currency, Bitcoin, right? So you want to give me a loan based on what I'm holding, also known as Bitcoin. Okay, so I can see there you're kind of using it under the premise of a security, right? We got another definition that says something given, deposited, or pledged to make certain the fulfillment of an obligation, right? Surety. An instrument of investment in the form of a document such as a stock certificate or bond providing evidence of its ownership. So look, when Bukele was talking about getting a bond created off Bitcoin, based on Bitcoin, that bond would have then became a security, right? And the backside of that bond would be the actual asset attached to it in that contract or in that bond. So let's imagine this. So let's see if we can understand this. All right, look, so I've got these rare cars, right? And these rare cars have a value, but I can't see the fulfillment of that value unless I sell them, and I don't particularly want to sell them. So I'll probably take a loan. I'll go to the bank and I'll say, look, based on this as collateral, these vehicles, could I draw up a contract where I use these vehicles as collateral because I own them? Here's the titles to them, and you can hold the titles until I pay off this debt, this loan I want to take, right? So essentially, what Bukele was trying to do in El Salvador is the same thing with Bitcoin, right? Well, I'm going to, generate this bond based off this Bitcoin, and this would be the contract. So that would then therefore make that bond the security, right? Is that what they're saying? It sounds like that's what they're saying to me. If anybody's getting that, show it up in the comment box. And if I'm misunderstanding this, please show it in the comment box. But that's what it looks like. All right, so we got an article from CFI. It says, what is a security? We get a little deeper in it, right? So it says a security is a financial instrument. Okay. Typically, any financial asset that can be traded. The nature of what can and can't be called a security generally depends on the jurisdiction in which the assets are being traded. So, all right, so we got here a financial instrument, right? So we're talking about moving money around, and an instrument that allows us to do that. Typically, a financial asset can be traded, so something that we can get value off of, that's an asset. So we're talking about, like, for instance, we use the example, rare cars, you know what I'm saying? Paintings, you know what I'm saying? These are assets that you can put in the contract or the bond. All right, or the security. All right, it says, and then it says the security depends on the jurisdiction, right? So who has jurisdiction of this particular contract, which is becoming a security, right? So, okay. Then it says, in the United States, the term broadly covers all traded financial assets and breaks such assets down into three primary categories. Okay, so the first category says equity securities, and this includes stocks. So we look at the stock market, boom, that's self-explanatory. So stocks are known as equity, right, securities. Okay. Let's see. And we know equity is like something that gains value. Like, oh, I got equity in my house. You gain value in your house, just like those stocks or shares of those stocks have gained value because now it costs more for those shares, whereas you paid less in the beginning. So you gained equity in that security, which would be that stock. It's just like, if you had a house and it gained in value like it did right now. All houses have gained in value during this situation that's going on. But we're not here to talk about that. All right, so then it says, number 2, we've got debt securities, and these include bonds and banknotes. Now, we've already been looking at banknotes, and these are just records of what's owed out that the bank has to pay out or pay for, right? So those are known as debt securities. So that's something that has to be fulfilled. So when those contracts, secured bonds, go into maturity, that's when they have to be fulfilled, and that's when you got to close out that debt, right? So there's your debt security. Banknotes, the money that's in your pocket is banknotes. So that means the money in your pocket are debt securities. And if they try to say it's not, then what is it then? The dollar, out of their own words, they said the only thing accepted for the payment of debt is gold and silver. All right. So dollars are greenbacks made out of paper that literally say on them treasury notes, treasury, right? Records, record keeping, right? Keeping track of the debt. So come on. Those are debt securities. The dollar in your pocket is a debt security. All right. Derivatives. Now this says this includes options and futures. Right. So when you look at the stock market, people do, I'm going to put an option in on this trade and a future on that trade. So you're again back in the stock market. You're talking about contracts that have to be fulfilled. Right. So that sounds to me like we're just saying securities are just contracts that have to be fulfilled. All right. So equity securities. Equity almost always refers to stocks and a share of ownership in a company which is possessed by the shareholder. Equity securities usually generate regular earnings or dividends for shareholders in the form of dividends. An equity security does, however, rise and fall in value in accord with the financial markets and the company's fortunes. So there's a company there, right? It says equity almost refers to stocks and a share of ownership. So there's a company, it does stuff, right? It makes money, and there's an ownership, right? And so your promise from your buying of these shares, you're funding that company, helping keep them afloat, right? And they promise you what? Earnings, right? So there's an equity security. Okay, so that's not too hard to understand, right? Debt securities. Debt securities differ from the equity securities in an important way. They involve borrowed money and the selling of a security. Now let's talk about this borrowed money thing. When we talk about the dollar is not paying for a debt. The dollar is a record keeping. That's the Treasury keeping a record of all of the borrowed or debt that the United States has. Now let me be clear to help you all understand this. As a United States citizen, we are all responsible for the United States debt as a whole. And don't just sit there and say, oh my God, well, the United States has made all this debt. That's not necessarily true. That's not true at all. Okay, so when we go out and we go buy homes and we take out these mortgages and these loans and all this stuff for these homes eventually get bottled up, brought into one container, and then sold on the marketplace to other countries. And then those other countries, this is why you get foreign people on your phone trying to collect debts, are coming after you to collect their debts because another country pays for those debts, right? You the citizen who has all these loans out through these banks, you are the reason why there are debts in the United States and that there's a treasury note, because you didn't want to pay in full to keep the treasuries notes true to booking, right? So if you got loans out, it screws up the booking. It screws up the books. Okay, well, so and so paid off their loan, so we've actually got that paid off. You know what I'm saying? But it's like, oh, because all these things exist on loans and contracts, they're not fulfilled yet. So we're hoping that they're going to fulfill these things, and other things happen and don't get fulfilled. But that's what we're looking at so far with a debt security, right? All right, so it says they are issued by an individual, a company, or a government and sold to another party for a certain amount with a promise of repayment plus interest. So again, an individual can sell a debt bond, right? So what is this, almost like a sublease, right? You know, well, not so much. They could essentially sell debt or sell something. Yeah, well, like a sublease. I haven't finished paying it off, but I go ahead and sell it to you, right? And then you take over, right? A company does what? They just bring the bonds together and they sell them to a whole nother company, right? And then your mortgage belongs to another company. And then the government, well, the government's the biggest of them all because they're the ones that are printing out these IOU notes while they have to make good by collecting taxes on all of us. And so that's why we're looking at these tax hikes coming, all right? All right, so it says, with a promise of repayment plus interest. So of course, that's the whole thing about a debt security. It's promise, right? Making it secured. It's promise that there's going to be a maturity of it where you'll get your money paid in full with interest, right? It's like the bank. That when you sign a contract with the bank, you signed a contract, a debt security with them, securing your debt with them. That contract. Look at it simply. The contract or the bond and the contract are one and the same. That is what secures that debt to the bank or to the government. Okay, so once they've secured that, it's a security because it's now in that contract that you're promising to pay the maturity of it, to pay it off. It's done. So there's a contract, those debt securities, that's what they are. It says they include a fixed amount that must be repaid, a specified rate of interest, and a maturity date. You see there, the interest is what's added on top. For me giving you this contract, and the maturity date is when it needs to be paid off. The date when the total amount of security must be paid. But see, there it is. Okay, bonds, bank notes, or promissory notes, and treasury notes, are all examples of debt securities. They all are agreements made between two parties for an amount to be borrowed and paid back with interest at previously established times. So again, United States citizens, those paper money things that you have in your pocket, those are not anything real or anything of significance. They're just notes, treasury notes that, hey, this debt that the United States as a whole has, including all citizens that have loans, listen, this is like one of the only places you can go and ask for somebody to give you an IOU so you can buy a home, a car, or anything else. That's like the only place that really does that. You know what I'm saying? And so this is why we're in the predicament that we're in now. So just think about that. Let's continue. Derivatives. Derivatives are a slightly different type of security because their value is based on an underlying asset that is then purchased and repaid with the price, interest, and maturity date all specified at the time of the initial transaction. The individual selling the derivative doesn't need to own the underlying asset outright. The seller can simply pay the buyer back with enough cash to purchase the underlying asset or by offering another derivative that satisfies the debt owed the first. All right, so this is more debt. All right, so securities are contracts, right? And there are contracts on equity and there are contracts on debt. Those are securities. Let's continue. A derivative often derives its value from commodities such as gas or precious metals, such as gold and silver. Currencies are another underlying asset a derivative can be structured on, as well as interest rates, treasury notes, bonds, and stocks. Now, when we talk about currencies and we talk about cryptocurrencies can fall under a commodity based on this. This is why they treat it like commodities, because it's a currency, right? So it can be structured as well as it can be structured on as well as interest rates, treasury notes, bonds, and stocks. Okay, so the way it can be structured is what can put it in the classification as a security. So derivatives are most often traded by hedge funds to offset risk from other investments. As mentioned above, they don't require the seller to own the underlying asset, and may only require a relative small down payment, which makes them favorable because they are easier to trade. So it's derived. from a commodity. So it's still talking about a contract. So a contract is made, and that contract, based on what it's derived from, is what makes it a security. So because a cryptocurrency can be structured similar to with interest rates, treasury notes, bonds, or stocks, then because of the way it can be structured, that contract therefore becomes a security, if I'm understanding this correctly, not the actual cryptocurrency. Oh wow. Woo! That is like, what, man? What? That's a lot. Did we get a breather? Did we get a breather? I don't know, man. All right, so we got the statement on registration of security-based swap execution facilities. This is Chair Gary Gensler, April 6, 2022. He says, today the Commission is considering a proposal to create a framework for the registration of security-based swap execution facilities. Security-based SEFs, I am pleased to support this proposal because if adopted, it would increase the transparency and integrity of the traditional, opaque, over-the-counter security-based swap market, fulfilling a mandate under the Dodd-Frank Act of 2010 to register and regulate the platforms that trade these instruments. So I would understand everybody make a fuss out of this because it's literally talking about bringing these a framework that'll bring these different swaps, right, in under jurisdiction. So for protection and every other reason. So that's the whole purpose we went through securities, to figure out what they're talking about, what securities really are. So yes, when we start talking about contracts that are mature and that are debt contracts and even the contracts, the equity contracts, we're still talking contracts, and this is where we're talking about security. So from my understanding, looking at this information, technically, until you start getting the ETFs and all these other things that they're doing, you really haven't touched the waters of security. Where we stand now, you do have cryptocurrencies that are acting as cryptocurrencies. I don't know if any of them are acting like securities at this point in time. It depends on if there's a company and there's a contract behind it. If there's a contract made saying that, and you purchasing this, you will at a certain date get this value, then boom, there's security. But if none of that's happened, I can't see how they'd be security. So that whole thing with the Ripple thing is kind of like null and void. It makes no sense, except for the fact that if there was a contract that was written and signed stating to these people that when they bought these XRP coins, that they were going to go up in value at a certain date, then it's really nothing they could do about that. So look, I'm gonna conclude with that. That's just little information on the security stuff, trying to help understand it. If you got any information you want to input, put in the comments below. If you'd like to hit that like button, don't forget to share this with your friends, family, loved ones, and those who might just need to hear this information. Thank you.